Michael Oliver identifies November as a decisive inflection point for monetary metals. Gold has broken multi-year relative resistance versus every major U.S. equity index, including the NASDAQ, which just happened, signaling a regime shift rather than a short-term trade. Silver has also broken out against gold. Goldman argues gold's medium-term outlook is being anchored by structurally inelastic central bank demand rather than speculative flows. October purchases stayed elevated at roughly 49 tons, despite futures volatility, reinforcing gold's role as a strategic reserve asset. Private investors remain underallocated, they contend, with ETFs still a small share of portfolios overall. There is an asymmetric upside, they contend, under Fed easing. And tokenized gold, including tether gold, is growing but remains marginal, acting mainly as a substitute or cannibalizing ETFs a little bit, rather than a new demand engine.
Vince Lanci is a macro and precious metals strategist focused on liquidity, structural market shifts, and gold and silver demand dynamics. He highlights November as a decisive inflection point for monetary metals, echoing technical analyst Michael Oliver's view that gold has broken multi-year relative resistance against every major U.S. equity index, including the NASDAQ. This breakout signals a structural regime shift rather than a short-term trade. Silver has also broken out against gold, a move that historically precedes powerful upside phases. Goldman Sachs reinforces the bullish case, arguing gold's medium-term outlook is anchored by structurally inelastic central bank demand, not speculative flows. October central bank purchases remained elevated near 49 tons, while private investors remain underallocated, creating asymmetric upside as ETFs and tokenized gold adoption slowly expand. Now, we present the clips from Vince Lanci's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Here's the markets. 10-year yields are up 3. The dollar's up 33. The S&P 500 is up 33. NASDAQ is up 176. The VIX is down 32. Gold is up 15 and change. Strong, but not crazy. Silver is up $2.17. Crazy and strong. 65.90. Actually pretty orderly when you think about it. 3.4%. But silver's not the killer last night. It's actually platinum. We'll get to that in a second. Copper up 4 cents. WTI up $1. Natural gas unchanged bid. Bitcoin down 940. Ethereum down 38. Palladium up 23. Platinum up 64, up 3.9%. I'm sorry, up 73, up 3.9%. Gold, silver down 65. Goldman argues gold's medium-term outlook is being anchored by structurally inelastic central bank demand rather than speculative flows. October purchases stayed elevated at roughly 49 tons, despite futures volatility, reinforcing gold's role as a strategic reserve asset. Private investors remain underallocated, they contend, with ETFs still a small share of portfolios overall. There is an asymmetric upside, they contend, under Fed easing. And tokenized gold, including tether gold, is growing but remains marginal, acting mainly as a substitute or cannibalizing ETFs a little bit, rather than a new demand engine. They also hint at what would make it a new demand engine, and we flush it out in our version of the story when we break it down. You can read the full story in Goldman. Tether gold makes an impression, and central bank buying broadens. All right, Michael Oliver put out a report on the weekend. The bigger game has just begun was our title for it. In his latest 360 weekend report, Michael Oliver identifies November as a decisive inflection point for monetary metals. Gold has broken multi-year relative resistance versus every major U.S. equity index, including the NASDAQ, which just happened, signaling a regime shift rather than a short-term trade. Silver has also broken out against gold. That's the channel that we talked about in the gold-silver ratio. Historically, a precursor to explosive upside phases. Mining equities, long discounted since 2008, another technical structure that he identifies, are now resolving decades-old valuation distortions and positioning to outperform both gold and the broader stock market. That breakdown, that chart, really something I would not have seen. It's really nice. There's a channel that we were in that we just, mining stocks broke below in 2008 and never recovered. Then we had this long, semi-long rounding bottom, well, 15 years rounding bottom, and now we just cracked out of the rounding bottom. So Michael argues that the market, having cracked out of the rounding bottom, should approach at least the bottom of that channel from before. It's actually a very insightful technical comment, and I subscribe to it. Anyway, you can read about those stories. You can read the full stories. Michael Oliver, the bigger game has just begun. All right, news and analysis. Before we get into the news analysis and the rest of the show. I had a conversation with Eric Young this morning or this evening, depending on your time zone, and we were going back and forth about the markets. A few things stood out. One is Eric has been saying for quite some time, whenever this market rallies, there are always people who try to talk it down by saying it's all speculation. And to be fair, in the past, there has been heavy speculation. But if you look at the data today, particularly open interest on the speculative side, both on COMEX and even in Shanghai, there really aren't a lot of longs out there compared to historic longs. Now, I can't speak to the Chinese CTAs directly, to be fair, but I can speak to the American CTAs. They are nowhere near as long silver as they have been in prior cycles, not even close. Now, it is true that we're seeing more buying at the ETF level. That's investor buying. What's different this time is how that ETF demand behaves. In the past, ETF buying was often tactical. It came in, and then it came back out when the dollar strengthened or when traditional Keynesian indicators flipped. Look at the market. The dollar's up today, silver's up. Doesn't give a shit about the dollar. Nobody's paying attention to those indicators anymore, as we pointed out 3 years ago. What you're getting now is much more buy and hold behavior at the ETF level. And despite that, or maybe because of that, silver continues to grind higher, even with a clear lack of speculative participation, especially when there is a breakdown of silver pricing to gold. Now, what is driving the market? Everyone's focusing on supply right now, I've noticed. No one's focusing on demand. Well, Eric and I focus on demand, at least right now. To put it very simply, Eric and I, in our conversation, he said, you have a liquidity problem, but it's not a money liquidity problem or a fiat liquidity problem. It's a metal liquidity problem. There isn't enough physical silver available. Does that mean there's no silver in the world? That there's absolutely a shortage? Maybe. Maybe not. On the surface, it doesn't necessarily look like the world has completely run out of silver. It looks more like some of it is being hoarded. When you step back and look at the facts, silver is getting harder and harder to obtain on the physical side, even without speculative demand. The point of liquidity is on the silver side. There's just not enough silver available. At the same time, you see tokenization ramping up in the US. You see Middle Eastern countries like Qatar and Saudi Arabia buying silver. You see India buying silver. You see China restricting silver exports. At that point, maybe we shouldn't be obsessing over the supply side. Maybe we should be looking at the demand side. Why is there suddenly so much demand for physical silver? Now, Eric and I have agreed on this when it came to gold before. We think new products are coming in silver as well, too. Don't know what they are yet, but it's consistent with the idea that we both approached of gold becoming an HQLA. It has to become a high quality liquid asset. That was my point. And Eric saying China's behavior is mirroring that of someone who's going to set up gold for repo. Well, HQLA and repo go hand in glove. So that's also consistent with what Judy Shelton has been saying, that you need metal collateral to counter the broader demise of financialization. The rise of tokenized gold and tokenized silver is key here, I think. Now, these products are going to make it possible for people without a lot of capital to own silver. When you combine that with the fact that physical metal is being hoarded and the fact that traditional silver owning demographic skews older, you start to see where this can go. Younger investors are much more likely to participate if silver is wrapped in a token.
Despite higher treasury yields and a stronger dollar, markets send a clear signal of shifting leadership. Silver surged 2017 up more than 3%, while gold advanced modestly and platinum outperformed with a near 4% gain. As macro and precious metals analyst Vince Lanci explains, these moves are occurring even as equities rise and volatility falls, highlighting a growing decoupling between monetary metals and traditional risk assets. Technical analyst Michael Oliver argues the long wait is over, noting that gold has broken multi-year resistance relative to major equity indices, signaling a structural regime shift rather than a short-term trade. Silver has also broken key long-term channels against gold, historically a precursor to impulsive upside moves. Importantly, this rally is not driven by speculative excess. Futures positioning remains light, while ETF demand reflects buy and hold behavior. Lanci and Eric Young point to a metal liquidity issue, with physical silver increasingly scarce amid rising global demand and accelerating tokenization trends. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos.